Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about how the trade war is impacting mortgage rates and what to expect next. Logan, welcome back to the podcast.
Sarah, why are you so afraid of me doing my own podcast?
Well, a podcast should be a conversation for the most part. Anyway, let's
I
dive
could
in.
have a lot of conversation with just myself. So, unfortunately, you're in an area that is it's been hard to get internet going. But today we have a very interesting topic: are trade war deals good for mortgage rates?
This is what's on everyone's mind because it's like, so far we haven't seen any deals, or at least no announcements of actual deals. We've heard, concepts of deals or whatever. But the question is, if that happens, what does that do to mortgage rates? If it doesn't happen, what does that do to mortgage rates? So let's dive in.
So let's go from the start of the year. We had a lot of people who did not like President Trump who said mortgage rates are going to go to 8% and this is bad, tax cuts, bond yields and everything. And where are we today? We have 36 trillion in debt. We have huge bond auctions coming up. We have inflation expectations rising. But as we speak right now, the 10-year yield is 4.17%. So what happened? The irony is that the people who weren't fans of President Trump's economic policies were actually the most bullish economic people in the United States of America. The irony of not knowing what you're talking about is that if you wanted the 10-year yield to go above 470, which was the peak forecast of 2025, was that you really have to be super bullish on the U.S. economy. I mean, the economy has to outperform, kind of like what we saw in 2023 when the economic data was really beating estimates and inflation was still hotter than what the Fed wants. The 10-year yield went up, as it should have. But we got to a level to where it was pretty much everything was kind of priced in. And now the trade war has happened and it's gotten bigger and bigger. There's a lot of trade tariff on, tariff off. But then when we did Godzilla tariffs, what happened? Bond yields, whiplash all the way down. Stocks were selling off, bear market, everything. Then a huge reversal in yields. And I think that huge reversal in yields, and that was the one time, but it actually happened 3 different times recently in the month of April. That probably got the White House a little bit kind of spooked. And now stocks have rebounded. There's more talks about trade war deals being done. And for right now, the bond market is 417. We're talking Thursday morning, literally 2 hours from this. Everything could change. Tomorrow morning when this comes out, something could change. But for right now, the market seems to like us getting to that point if it does occur.
Isn't the reason we had things calm down, though, was because President Trump said he pushed off the tariffs for like 90 days?
No, because that didn't work either. Bond yields reversed on that as well. I think that Bissett and got in there and got him to do that because yields reversed that initial. But we're talking about today. I said if everything was constant and then there was no trade wars, the 10-year yield based off economic data should have been around 4.35 as the economic data was getting softer but not breaking. But how do you account for economic data when we have so many people getting ahead of the tariffs by buying stuff, right? So the economic data is a little bit disjointed, but the labor data is still intact, right? We're almost in May. And with the labor data still intact, 10-year yield where it is in the range looks fine where Fed fund policy is. But now we're heading down to 417 for anybody who does a chart, who knows what I'm talking about. It does look like a head and shoulders. So the point of the article that we wrote yesterday was to say, well, assume that we get a bunch of trade deals very fast because the clock is ticking. I think President Trump this morning, there was a headline that Amazon's going to show their tariff price, like what was going to increase. And the White House was an uproar. You're like, what are you doing? This is political. It's against us. And I was like, guys, this is your tariff policy. This is what's happening. But you can see what's happening. Time. Right? What do we talk about? It's very, very hard to do trade wars in America because of a 2-year political cycles. Rand Paul has enough Senate votes to override the president's tariff power. He wants to take it to the House. The House won't do it. You see we are starting to get into a phase to where something either has to happen or everyone has to accept that this is going to be the case until you get either the American public fed up with it, or Congress comes in and does it, or the courts change it. So right now, it looks like the markets for now believe that there will be a deal in the future. Right now, it doesn't look like anything is set in stone. There's all these reports about this is happening, that happens. But for right now, we can see that not only the stock market, but the bond market is not only calm, but it's heading lower, because what's going to happen is that eventually, in a few months, if things don't improve soon, you're going to get some job losses, right? Logistics, trucking, tourism, then you start to say, okay, well, the 10-year yield getting down to 4% or even touching the borderline makes sense. Now, the question is, what does the Federal Reserve do at that point?
So from your perspective, either way, we should see mortgage rates come down, right? Either they come down.
Mortgage rates have come down. So let's give an idea of what we're dealing with. All right, so the mortgage rate forecast this year was 7.25, 5.75, same thing as last year. Spreads were getting better, and then the trade war tap dance, Godzilla tariffs actually made it worse. So right now we're about the Godzilla tariffs cost us about 20 basis points on mortgage rates. We're not nowhere near 2023 levels, but the spreads have gotten worse recently. We went from 7.25 down to 6.55 to 7.10 to now 6.80. If the spreads were at the best levels of 2025, we're at 6.60. So we're dealing with a smaller range here, but the volatility has made the spreads go worse. But assume that everything is going to come back online very soon. I was showing this chart on my Instagram stories that if you look at the growth rate of inflation, not only here in America, but all the G7 and G20 countries, they all kind of look the same, right? We're the one with a strong recovery. We're the one with fiscal dominance and getting people checks and everything. And yet all the growth rates of inflation look the same. So we have the potential of having a very bullwhip effect on some of the inflation data if you start to have this progress bigger, longer, wider shortages. Boats aren't in ports anymore, so something's going to happen. And then you get this bullwhip effect, because then if supply gets better, that's important in the article we wrote, because if the Federal Reserve thinks, okay, we don't have to worry about this in the future, the trade wars, assuming, hypothetical, I'm just going to do a hypothetical, that they really bring the tariffs down or something in that nature, and then we go back to, okay, well, there's a lot of damage done up front, let's prevent a recession. So the Christopher Waller premise, if I see the labor market breaking, I want to get ahead and do more aggressive rate cuts. If the Fed funds rate got 1% lower, it's easier to get to 6% rates in that sense. So here we are, 4.17 on the 10-year yield. So we would normally be about 4.60, 4.5 right now if spreads were as good as levels that we had in 2025. If we had normal spreads, we're sub 6%, whole housing market dynamic shifted. We'll see if the purchase application data improved a little bit or still in the downtrend. But we had a good start to the year up until rates spiked up. Still positive year to date, still positive year over year. But shocks like this, people get to see what happens or how the market reacts. So what we're seeing is that the markets tend to act better if there's discussions of trade deals, and then we'll see if we finally get a few. Because once you get a few countries in the works and done, then you could actually start, okay, well, we got this one done, that one done, that one done, this one, this, who's next, and we take it from there.
I think that's my question, is like, when you have such widespread, you call them Godzilla tariffs. I love that, because it just captures the fact that it's so widespread. How long does it take to get things back to normal? Even if everything happened tomorrow, what is that lag time?
That is out of my wheelhouse. I'm not versed enough in the logistics of how fast you could get things moving again. Of course, COVID things drug for a very long time. But when you do Godzilla tariffs on everybody, see, in 2018, 2019, it was kind of had, well, we'll go after the EU, we'll do some deals, NAFTA 2.0, and then China. That wasn't that big, and it caused chaos, but it didn't cause enough chaos for the growth rate of inflation to take off. The growth rate of inflation was actually falling back then. Logistically, I just don't know. Logistically, I don't know, and I don't know what deals need to be done to fix the whole system. But still, if you start to get deals announced, then people don't have to worry about, okay, this is the Titanic, or what I always say, that if you really believe in tariffs, you just put them in place and you don't negotiate anything. You're just going to change behavior over 5, 10, 15, 20 years. But if the deals happen, then we get to operate in a little bit more stable. Because remember, we all knew tariffs were coming. We all knew tariff on, tariff off. But Godzilla tariffs, that's a whole different thing, right? And we could see the market reaction right away. Whoa, what is this? And it gets, every day that passes on, especially with the tax cuts not in place with Congress and everything, closer you get to midterms, it becomes a little bit more challenging.
Yeah, those are really great points. And I don't, I'm just used to you being able to answer anything, Logan. So I'm just throwing all this stuff at you. I think the truth is nobody knows how long it might take to get things back online. Even if things happen right now, I think that's part of what everyone's trying to figure out, because this is pretty unusual.
Yeah, it's just when you're dealing with trade wars and other countries, everything has to start to get back to normal before you get it. And then when you don't see ships coming into ports, oh man, the ports, the people that were working at the ports that were doing the strike, saying that, hey, listen, we run the country, we're going to go on strike, and nobody gets any deals on. They're upset about tariffs now. They wrote a letter saying, oh, these are taxes that I think they probably get paid with certain kind of volume out there. So chaos. Every year there's something we got to deal with, and this is it. But we try to let the market tell us what, mother marketplace here, and so far it's telling us that they like the idea of this getting to some closure. And that's why the 10-year yield is at 4.17. Now, anything can change or something like that, but I think if the Fed can take away the worst parts or the massive parts of the Godzilla tariffs, then they have a better idea to, okay, let's make sure the labor market doesn't break. Because we're sitting here still, it's jobs week, job openings data came out. Okay, the headline data is down a little bit. The quits percentage is up, softening but not breaking. Breaking data looks a lot different, but we're starting, we get all these announcements about, UPS is going to fire 20,000 people and X is going to fire. Just always remember 1.5 to 2 million people lose their jobs each month. When the economy starts to really slow and consumption slows, it broadens out and then you get more layoffs and no hirings. We're in that. Hiring is very low. Firings is not really happening in big scale terms yet. So the job openings data is probably something where the Fed wants to see, back down to pre-COVID levels, but the quits percentage is picked up a little bit, but nowhere at elevated levels for them. So I think they're a little bit encouraged with the job openings data. But as you can see, oh boy, interesting. It's really interesting to see the bond market calm down since last week and still going into this week. Right now, and it's jobs week, so we'll wait and see how the rest of the labor data comes out and how the bond market reacts to it.
Yeah, put yourself in your mortgage loan officer hat. Okay, you did that for many years. You're sitting out there right now, and you're doing that. You have, you're still doing business. I'm at a Texas Mortgage Bankers Association event conference right now. They're doing great business. Everybody's talking about it. But like, how do you run your business not knowing, like, with this kind of uncertainty out there?
Well, you basically run your business like you always do. You kind of focus on the clients and focus on what you can control. Obviously, your job is to pre-qual people and get their real estate agent the data. But in this case, let's be mindful. We're not looking at any rate and term refinance boom happening anytime soon, because mortgage rates, ran the channel last year, getting down to 6%. So there's a lot of people that are already actually taken off the grid on the supply of refi. So you focus on the purchase, and what you're seeing is encouraging, because remember, at the start of the year, everyone said, well, inflation, tax cuts, everything, mortgage rates are good, and it did not happen because those people were so bullish on the U.S. economy, and it just didn't occur. The channel's there. Fed fund policy really allows limits to where the 10-year yield can go. But here, if you're a mortgage person, you're thinking, whoa, maybe there's a light at the end of the tunnel. Because what you can't have is the volatility. The volatility is it's horrible to work in, right? Where you get rates coming down a quarter, then all of a sudden jumping up 37 basis points, and then you can't quote, you can't do anything. It's just absolute chaos. So if you're a mortgage professional, you're thinking, okay, I like this. I like the calm aspect. Okay, slow and steady wins the race, Wheeler. Right? That's the motto. And in this case, you could only do so much when you're dealing with crazy headlines. But you could still see the construct of where rates should range in 2025.
No, that's so good. That's always, I feel like people have to do what they can control, to your point. It's tough to know, and it's tough to know when it's going to get better. But like you said, I mean, right now, at least rates aren't 8%. They're not 10%. We had some people saying that not even that long ago.
Yeah, I mean, the worst case scenario is that the bond market does something that it shouldn't have done. The 10-year yield goes north of 5. By the way, everyone, I always ask this question. It's 2025, and we were told that no person on planet Earth is crazy enough to buy the 10-year yield at 5% in 2023 because we're broke. And I'm sitting here looking at the chart, and literally the entire world must be crazy because the 10-year yield has not broken above 5% since 2023. So always be careful of who you listen to. We joked about that on today because the Case-Shiller index came out, Case-Shiller Home Price Index, near 4% growth year over year nationwide. The top 20 cities were like 4.5%. And we're sitting there thinking, guys, it's almost May of 2025. If you are absolutely listening to any of these terrible YouTube accounts and Twitter accounts and X accounts, homie, you are getting so played. They're just laughing at you because it's just not here. It's just not been in the data for many, many years. And for me, again, my forecast for prices this year, 1.77%, that means real home prices are negative. Case-Shiller lags a little bit, so we believe the pricing growth is actually slower than that. But in that case, hypothetical, let's say PCE inflation is running at 2.5%, CPI inflation is running at 2.9%. That would mean real home prices would be positive if it closed at near 4%. I'm actually wanting price growth to cool down, right? Because every year it cools down and inventory comes up, healthier housing market. That was the last podcast. But again, now that we're almost in May, just remember, you can choose who you listen to, right? You could listen to doom porn, and some of you should listen to doom porn because I don't think y'all got anything else going for yourselves. So that's your crew, right? Or if you really, really wanted to learn, right? If you really cared about learning, we would say education, the best thing to deal with fanatics over the last 2,000 years is educating people. If people could read and write, right, and do math, oh my God, it's very hard to manipulate people that are educated, right? But in this case, it's May. It's almost May 2025. Let's realize. Let's kind of move on from the doom crowd and don't let that whatever Mickey Mouse talking points they've done for so many years get too much airway.
Okay, so all of that is very important. But one thing we have to revisit is the putt conversation, because how many messages did we get overall?
I lost the putt. I stopped counting after 1,000. I think it was, if I stopped counting at 1,000, I had 8 people that said, it's miniature golf, but it's over 1,000 putt. So I'm a West Coast guy. I've never even heard that term. So learn something new all the time. But Sarah Wheeler, a rare win for Sarah Wheeler against Logan.
Even today, I was sitting in the meeting for the TMVA, and this guy just walks by and says, Sarah Wheeler, and he put out his fist. He's like, putt, and then he just walks on. I don't even know who he was. It was so funny. I have gotten so many messages. So all of you, thank you so much. Thank you for affirming that I am not the crazy one, at least at this time, in this instance.
Sarah, enjoy this day. Relish it. Think about it. Write a book about it. Doesn't happen often, but you got me on this one.
There will be other wins. There will be, but I just want to say too, thank you to all our listeners. You guys are great. There's so much engagement on this. You texted me, you emailed me, you went on Logan's social, you emailed him. It was pretty fun. The cherry on top is I was right. So there you go. But the best part of it was just engaging with so many people. So we will have more of this coming as we tackle both the really serious things and the not so serious things. So Logan, thanks so much for being on today. You know, we're going to talk it to you very soon, a couple days from now, and everything might change.
Yes, we're going to prep for Jobs Friday next. Woo. So much fun.
So much fun. Thank you so much.